Well, good afternoon. Thank you for joining us for our Navigating the Home Buying Process webinar with an emphasis on how to obtain a home loan. I'm Corby Gage, the Executive Director of Coastal Housing Partnership. And with us today is also Kim Pascage, who is the Program Manager for Coastal Housing Partnership. And today's webinar was supposed to feature 3 local loan officers, but we had a last-minute illness from one. So she was sending her regrets and so sorry she couldn't be with us today. And so our other 2 panelists are going to jump in, and you'll still get all of the information that was planned, and we'll just pivot a little bit. So with us is Austin Lamson from Homeowners Financial Group in the orange waving, and Roy Torrance from Dignified Home Loans, who is now waving, taking a cue from Austin. So thank you both for joining us. And Cindy again sends her regrets. Austin and Roy are both part of Coastal Housing Partnerships Network. And what that means, being part of the network, is these lenders reduce their closing costs for their clients who are part of, who are employed by companies that are part of Coastal Housing Partnership. The format for today's webinar is I will be asking Austin and Roy some questions about the process of obtaining a home loan. And then the remainder of our time together will open up for your questions. We want to make sure we're getting your questions answered and addressing your needs. So that's really important to us. We will be recording today's webinar, so we can send you a link to that recording. And the webinar format means that your cameras are off, your microphones are off, so we can't see you or hear you. If you do have questions, and we encourage you to ask your questions, put them in the Q&A, and you can put them in there at any time throughout the webinar, and we'll get to those toward the end of our time together. And you can ask those questions anonymously if you like. There's an option to do that. So since the first step in the home buying process is meeting with a lender to find out how much of a home loan you can afford, the information you're going to get today is going to be really important in terms of having you be a more prepared home buyer and feeling confident in taking that important first step. So before we hear from our panelists, I want to remind you that one of the benefits that you have, since your employer is a member of Coastal Housing Partnership, and that is the home buying program benefit. So that means that we've partnered with a number of local real estate professionals who provide savings on the closing costs for our employees. So these professionals include lenders, real estate agents, home inspection firms. We work with a moving company and also a residential developer. So when you are using these professionals to buy your home, they will save you money on your closing costs. Generally, you're saving about 50% or more on your closing costs. And you can find that list of partners that we work with on our website, coastalhousing.org. And as I mentioned, Roy and Austin are part of this network. So we encourage you to use folks within the network and save money on those closing costs. So let's get started. Austin, would you please share a little bit about yourself?
Sure. My name's Austin Lamson. I'm with Homeowners Financial. I've had the privilege of serving our community in residential mortgage lending since 2002. I was an assistant from 2002 until 2007. I went into operations and then switched into originations, which is what we call loan officers, in 2012. So I have seen a lot of changes in lending, right? Shall we say? I've been on the underwriting side, so we know a good balance, in my opinion. I think it's all math and emotion, and I think you have to nerd out and help people. And that's why I'm so grateful to be here today with people like you, Corby and Roy, who really take that higher level of communication for clients.
Great. Thanks, Austin. Roy, would you introduce yourself?
Hello, everyone. My name is Roy Torrance. I'm the branch manager at Dignified Home Loans. We're in Ventura County. My office is in Oxnard. I've been doing mortgage for about 15 to 20 years. And prior to that, I kind of had an entrepreneurial background, owned my own companies that and then selling off and then kind of fell into this industry. But I've been doing it quite a while now. I really enjoy being able to help people achieve their dream of getting a home. And I'm positioned here to try and share some of the knowledge I've learned over the years with you guys to help everybody navigate through the process of obtaining a home loan. And so that's why I'm here.
Great. Thanks, Roy. So Austin, let's start with you. You know that there's so much conversation these days on whether someone should rent or should they buy. I think it's really helpful to understand the benefits of home ownership when someone's making this decision so that they can make an informed decision. What do you think are some of the benefits to an employee and their family when comparing home ownership versus renting?
Oh my gosh, it's such a great question because we know it's not cheap, right? And it's not really, rates may come down, or however, we don't really see that prices are going to be drastically coming down. So I think going back to what I said in the introduction about being a balance between math and emotion, there's the math around it, right? There's 50, 60, 70 years of evidence that homeowners have higher net worth than renters. You're building your equity. You are able to save because you have tax benefits that other people do not. You are going to be able to level up and buy additional properties, maybe turn into rentals. So there's a huge financial benefit. However, there's also the emotional side. And I'll tell you one of the main reasons that I believe in responsible lending so much here is the stability of housing, because we aren't building enough. We have not built enough for decades as a country. And I know that if you have a stable, good financial plan and you have a stable roof over your head, you're better at home, you're better as a neighbor, you're better with your kids, you're better at work. So when you're looking at rent versus own, we've got to weigh what is that emotional side of it, that stability you're creating, the pride of ownership, the being able to do what you want to it versus the financial, because it's not cheap. There are rates and programs that can give you hacks and strategies around lower temporary rates today, whether it is a loan that's adjustable for a period of time or a temporary buy down, which are, I think, amazing, that's going to bring rates lower 1 or 2 or 3% from today's rates and still provide you a fixed rate. So overall, from a benefit standpoint, we've got to, again, look at that math side of what it means to you for the long term, not simply comparing what your rent may be versus the mortgage, but that long term. And then, of course, that emotional side, what it means for you to be able to grow over time.
Mhm. And there might be some tax benefits to homeownership that can factor into making that more expensive mortgage payment not quite as expensive compared to renting.
Right. I mean, the rule of thumb is that you get about a quarter back of your housing payment,
Mm.
mortgage, taxes, insurance, association, you just get about a quarter back. Now, I will tell you, and this is for everyone, there is a great resource Freddie Mac has, which is, let me pull it on the screen. Forgive me while I squirrel on us, which is Freddie Mac has something called Tax Savings Calculator. I like this because it's a public website. It is completely unbiased and it is based on national data, and it's free and not trying to sell you anything. So if you want to look at your parameters for maybe something that Roy's put together for his team, Cindy's team, right? When she's feeling better, I know she's got a great team behind her, even if she's out, and any other lender that you're talking to, it's going to give you some pros and cons and where that might work for your personal situation too.
Oh, great tip. Thank you. Thank you. So doesn't mean maybe someone should wait to start this process, waiting for interest rates to come down. Maybe, they should get started today, even though we see a little higher interest rates.
Oh my gosh. Someone's like, when is the best time? When do I talk to a lender? I said, well, you thought about buying a house, so absolutely now, right? Because Google's great. However, with all due respect, Google, you can lie to us, right? I mean, it could be something that is in Northern California, which is different than here, which is different than LA versus Massachusetts or Arizona, right? It's too broad based. And those mortgage calculators you see online, again, are too broad based. So anytime you're like, gosh, is this something I want to do, whether it's today, tomorrow, or 5 years from now, sitting down with a great lender is going to help you determine what that actual plan is, right? You don't have to be ready today. You'd want to be able to develop a game plan because most people say, oh, my credit score is great. And as Roy can probably attest, like, it's not just your score, it's all these other factors, right? So that's part of the reasons why you work with a local human lender is because we understand those factors. We understand how it's different for our neck of the woods here in the 805 versus, say, again, a different part of the state or country.
Yeah, it's so interesting. I've heard so many people look at those mortgage loan calculators and kind of self-eliminate, going, oh, I can't do this. There's so many factors, Austin, as you mentioned, that go into this approval. And, why take that risk of just going, oh, well, I looked at that, it didn't make sense. It's like, whoa, talk to someone, an expert who knows and can help you get a game plan. So I think that's so important. So even if someone's not ready to buy right away, maybe they think it's 2 years away or 3 years away, is it still a good idea to meet with a lender now?
Absolutely. Yeah. Again, you need to have a game plan. You need to understand what your personal goals and the market opportunities are blended together to make that happen. Right. And that's really going into that pre approval process. Now, the pre approvals are going to look at your income, they are going to look at your assets, they're going to look at your credit, everything but the property. If that's what we're reviewing, someone gave me a pre approval letter from an online lender, and I was like, cool, how much information did you buy? They're like, zero. I just entered in data. I'm like, then it's not worth like the paper it's generated on, right? You really have to dig into, maybe you get restricted stock units, maybe you get overtime, maybe you switch careers, right? What does that look like? And a pre-approval is going to dig into that, and that's why it's so drastically important that you're talking to a real local human that's going to develop that plan for you and walk you through that process.
So what's involved in that pre-approval process? What are you asking for as a lender? What do people need to provide you? What happens during that process?
Absolutely. So remember, all loans have four bases: income, assets, credit, property. All loans have four bases: income, assets, credit, property. And it's like that Jenga game, right? It's like the building blocks, like, oh, well, if I remove some assets here and I pay off some debts there, right? Or maybe my income just started on my side hustle, but I can use that money for the down payment. So when you're looking at a pre-approval, you're going to take someone's goals and needs and opportunities and their boundaries. Here's how much cash I can bring in. Here's where my affordability is. And then we're going to analyze the actual documentation behind it. So, yes, we're going to ask for pay stubs. Yes, if you have a family K1, we're going to ask about that. Yes, we're going to ask to see all pages of your bank statement. There are so many regulatory reasons why I think that would bore people, of why we have to look at everything. The main reason to know is that there's legal ramifications based on documentation, based on information, and that pre-approval process wants to go through everything so you don't fall in love with the house and then OMG, now you can't do it. That would like just break my heart. That would break my heart.
Yeah, I think that's so important. Just that confidence. Once you have the pre-approval, I know I can afford this loan. I've worked with the loan officer. They've said this is the loan amount, this is what the payments are. And so when you go to make that offer on a home, you're confident that that's something you can do, and not that, oh, like you say, you fell in love with the home and then you find out you can't afford it. So that just gives you such confidence in your home buying search, and really gets you targeted in terms of, what should I be looking at? What's my actual price range, instead of kind of a guess. Most people, when they're guessing their home price, what they're eligible for, are pretty much wrong, because there's so much that goes into it. Why not know for sure? Now,
Well,
what about the pre-approval? Oh, sorry, go ahead,
no,
Austin.
I was going to lead in with that. I always tell people it's like doctor nurse, right? So your loan officer is your doctor. If you just simply say, hey, what's your interest rate? That's like asking a doctor for a prescription without meeting with you, right? Well, what's going on? Oh, I have a sinus infection. Well, what does that cost from? Well, I eat a lot of spicy food. Okay, well, that's different than you have allergies or you broke your nose or, right, that there could be some fungal infection out there or there's mold. So think of your lender as your doctor that needs to know everything and should go through everything with just cause so that you have that right prescription to move forward.
Right. Now, this pre-approval is there, it sounds like it's a little bit of work for the lender to go through. Does it cost anything for the home buyer, potential home buyer to get a pre-approval?
That's really going to vary. Some companies do apply a required application fee. Some companies do have a credit report fee. Roy, how do you guys handle that on your side?
Actually, there's no cost for pre-approval because it's our job, and any credit report being pulled or the cost of it's the cost of doing business.
Yep, I'm right there with you. We don't have a charge either at all. We do everything. I mean, we're actually the cheapest part of the process. We're all free until we close.
Mhm.
Right.
Yeah, so you might as well, proceed with that. It's not costing you anything. Now, if someone's getting a pre-approval, say they're not ready to buy right away, but they're
Yeah.
working with this lender to get a game plan, they have a pre-approval. How long is that pre-approval good for?
Again, you're going to have some differences probably based on company policy. My theory is it's good until your life changes or loans change. And so in my world, we have to make sure that we're reaching out to our clients and having conversation. If you got pre-approved a year ago and you email and say, I want to make an offer tomorrow, that's not valid because you haven't replied to anything. You obviously have a new W-2, right?
Mhm.
Your bank account is obviously different. Your credit report is obviously different, right? So as long as we're in communication, we can keep that fluid. And it's absolutely our responsibility to make sure that you're aware if loans change. Roy, how do you guys treat that?
We do it at 120 days because
Okay,
that's how long the documents are good for in the
great.
event you did go into a purchase contract in theory. So every 120 days, we can simply extend it another 120 by just saying, hey, has your pay changed, bank account changed much? And have you charged a bunch of stuff that you didn't have charged before? If the answers are all pretty much no, we just reissue it for another 120. Technically, we're supposed to get some of those documents again, but we kind of shoot from the hip based on the report with the client, but it's really the same as what you're saying. So
So it
yeah.
sounds like it's a pretty easy process to refresh that pre-approval.
Sometimes it's as simple as clicking a button and issuing a new letter.
Okay, great. And I can imagine when there's multiple offers on homes that pre-approval submitted with your offer is just really essential to have that in order to get your offer even looked at seriously.
Yeah, absolutely. No seller really wants to give keys or put their keys, on hold for another qualified buyer if you aren't able to perform and really from that loan standpoint. That
Mhm.
is the worst part of it, right? I mean, there's investigations, that's totally different. We're not talking about the quality of property here. We're talking about the quality of your qualifications and the money to make sure it's there on time.
Great. Okay. Also, you're talking about these four aspects of that pre-approval, credit being a big one. Roy, um, it seems like it's hard to go through a day without hearing someone talk about credit or credit scores. Let's talk about that a bit. Why is credit so important to the lender? And, why is that credit score so important?
Well, first of all, I think I'd like to preface this with what is a credit score? What is FICO? Why is it here? How did it come about? And I think it's a really interesting concept. FICO scoring was created to predict a surgically specific single question. And that question is, what's the likelihood that you will go 90 days late on a payment in the next 24 months? So I'll repeat that. What's the likelihood that you'll go 90 days late in the next 24 months? So that singular question was the foundation that the FICO scoring model was created to answer. So that's the premise of FICO, and that's how it came about. And so that kind of leads into why is credit so important, right? Why is your credit score so important? And I kind of like think of it as it's a foundation that either opens or closes doors to possibilities that could potentially improve your life. And that sounds kind of philosophical, but I think it is an accurate, honest answer to why it's so important, because it literally does open or close doors to possibilities. One could argue some may or may not make your life better, but the point being is it's the possibilities that we're concerned about, right? And possibilities like being able to rent a home, buy a car, getting a credit card so you can buy airline tickets online, concert tickets, or the convenience of not carrying cash or anything related to do with credit. It's not always about buying stuff that you can't afford, which is the big joke that everyone associates with credit, and for good reason as well. But my point is there's actually real day-to-day practical reasons that we need to have credit that have nothing to do with buying something and then making payments on it because we want it now. Like I said, concert tickets, airline tickets, practical items. So credit score is important for those reasons, right? And it's actually got to be part of how you manage your life. It is a component of day-to-day life. Like it or not, it is.
So Roy, what happens if someone doesn't actually either know their credit score or thinks they don't have good credit? I hear so often people will say, well, I'm trying to get my credit in great shape before I go see the lender. And I always think, oh, no, maybe that's not a good idea. It seems to me like it's a good idea to talk with the lender about what things you might do to improve your score. Is that something that you generally suggest?
Absolutely. Only because it's kind of like the abyss. How does it work? What affects what? If you push on the left, does it pop up on the right? So kind of having someone that you are able to rely on to help you navigate as a roadmap through that is such a huge assistance. And you can do things that you might think would improve your score, but could actually hurt your score. So that's another cautionary thing. I guess we can break this down. How is your score determined? Right? And I'm just going to throw some percentages and stuff at you guys. Don't expect you to regurgitate them or remember them verbatim, but it'll at least give you the flavor of how is my score determined? Well, 35% of your score is based on your payment history. Did you pay on time? Are there late payments? 30% is on the balance of your outstanding debt. And the balances on the accounts. But more importantly, it's the percentage of credit that's being used that is actually a determining factor that can affect your score. So if you're using 20% of your available credit, so your credit line with all your credit cards is $1,000 and you're using $199, you're just under 20%. It's going to have a nominal impact on your score. But if you have $1,000 available credit between your 2 or 3 credit cards or one credit card and your balance is $989, you're at about 99% of the available credit. So managing the percentage of how much you're using of what's available has a determining factor, and it's weighted at about 30%. 15% is on your credit history. And this isn't how you paid. This is how long has that credit existed? Have you had that Target card for 1 month or 10 years? So length of credit history also is important. It's a reason that you never want to close a credit card in most cases, especially if it's one that you've had for a long time. We'll talk a little more about that in a minute. So we're up to about 80% of the percentages on what gets your score. 10% also is the type of credit that you have. So there's revolving credit, like a credit card, a Visa, MasterCard, American Express. There's also installment credit, like payments for your car. It's the same amount every month, right? And as you pay it off, you don't get to go spend it again. It's an installment loan. So the type of credit does affect your score as well. It's good to have a balance. You don't want all revolving credit. Having an installment loan does help your score. And most people use installment loans mostly for their automobiles. That's the classic example. But there is an art to having a balance to your usage of credit, and that accounts for about 10%. The last 10% is on the inquiries. How many applications for new credit have you put in for? It's funny that the inquiries really only counts for 10% of your score, but yet that's the one that everybody knows about. Don't pull your credit, it's gonna hit your score. But the truth is, mathematically, it's only about 10% of the factors. The reason that there's so much focus on it is it's immediate, right? When you charged up your credit card and broke into using 20% of the available credit to 50%, you don't know your score really changed much. And it takes a while for all this reporting to happen. When you pull your credit at Home Depot to get the extra 10% off and get a Home Depot card, you get your score is hit immediately. It does account for 10%. It is a valid reason, but just to keep it in perspective, it's actually about 10% of your overall score.
So when someone gets a pre-approval, and they're getting their credit pulled, is that going to be a negative to their score?
So most mortgage banks are pulling a regular 3 bureau credit pull on the client for the pre-approval. And there's a reason for that. The typical hit, though, is between 1 and 5 points, and the effect of that pull dissipates very quickly. And the reason is, unlike the Home Depot example I gave you, where you applied right there, Johnny, on the spot while you're buying that item and getting 10% off, they immediately issued you a credit card. Not a card, but they'll give you your temporary card on a piece of paper that you can use for that purchase. That means they actually issued you credit right there, Johnny, on the spot. And you've got no credit payment history for that new trade line. So that's going to affect how fast your score recovers. And consumer credit typically does ding you a little more than an inquiry from a mortgage. So I try to let everybody know, don't be overly concerned when it comes to a mortgage inquiry, because you're not immediately getting your credit pulled and getting handed a check for $500,000 and says, here, go buy a house. I mean, you may not even get a loan even if you qualify. It is a pre-approval usually in most cases. And so the mortgage inquiry, typically 1 to 5 points, and typically starts recovering within 30 days. So it is a nominal hit, but it is a hard pull. Some lenders are now promoting that they're doing a soft pull, which is typically going to be only 1 bureau. And the problem with using that, in my opinion, is that when you're doing a mortgage approval, they take all 3 credit scores from Equifax, Experian, and TransUnion, and they take them for all the borrowers. They throw out the high score, they throw out the low score, and they use the middle score. Then they take the lowest middle score of all the borrowers, and that's the score that gets used to calculate your interest rate. And the foundation of your loan's FICO score is based on the lowest middle score of all the borrowers. So when you do the soft pull, it's only 1 score. We don't know if that's your high, middle, or low. So anything that we're going to tell you from doing a soft pull potentially could be inaccurate. So I say, don't be afraid to let a mortgage banker pull your credit report, because it is a nominal ding to your points, and it is a very quick recovery. And quite frankly, you need that information to disseminate to them so they can give you accurate information. I will tell you.
Sounds like it's a lot of good information. And so it sounds like there's a big difference then between a mortgage loan credit score and a consumer credit score.
So that's a really good point you're bringing up. So we said that there's 3 credit bureaus, Equifax, Experian, and TransUnion. So everybody has 3 scores, but everybody actually technically has 9 scores, because those 3 bureaus have 3 different algorithms to calculate your score, and they weight and look at your credit in a different manner for each one. One is consumer credit. That's anything other than housing or an automobile. That's all lumped into one category. So you'll have 3 scores for consumer credit, but then for housing, mortgage, rentals, you'll have 3 scores from the same 3 bureaus, but a different algorithm, and there'll be a different score. Same thing from autos. Now, on the housing and the automobile part, this is important. Once somebody pulls your credit, for the next 30 days, you can pull your credit 1,000 times from a mortgage or if it's an auto. Those are the 2 categories of supplies. And they call it the same day elimination, or basically it counts as one pull. So if they didn't have that feature in place, how could you shop around for a car or a home loan, which are the 2 largest purchases that a consumer makes in their lifetime? So yes, there's 3 bureaus, but yet there are 3 separate scoring rhythms. You could have Experian for consumer credit at 710. You could have Experian at home loans at 705, and you could have Experian at auto loans at 698. Same bureau, but 3 different categories, 3 different algorithms.
Okay, Roy, this is a lot of great information. My big takeaway is going to be credit obviously is very important to the home loan and what interest rates you're going to get, what loan programs are available, and that I wouldn't suggest that anybody do anything to try to improve their credit other than paying on time all your bills every month without talking to a lender. I think that makes a lot of sense to check in with a lender, let them look at your credit report, how that looks, because what someone does to improve their score might be the exact wrong thing for you to do to improve your score. So check with a lender before doing anything. So thank you. That's such great information. Let's go into first-time home buyers and what kind of first-time home buyer programs are available. Who's considered a first-time home buyer? We always get asked that question. It's like, I'm going to be a first-time home buyer. Is there any special loans for me? Can you talk a little bit about that, Roy?
Sure. So a first-time home buyer is defined by Fannie Mae and Freddie Mac as someone who has not owned a home in 3 years, in the most recent 3 years. And there's been some discussion on this where some rules say you couldn't have owned a home that you lived in for 3 years. But I just did a follow-up on this with Fannie Mae and Freddie Mac, and they're very clear. Their current ruling for a first-time home buyer is you have not owned a home in 3 years. So if you inherited a home a year and a half ago from your mom and dad that live in West Virginia, and then they passed away and you have their home and the home is in your name, you are no longer a first-time home buyer because you own a home and it's been within the last 3 years. So that's the rule for a first-time home buyer. First-time home buyer programs. There are lots and lots of first-time home buyer programs. Some are funded by federal government, some by the state government, some by county and municipalities. In California here, there are 2 big agencies, Cal HFA and GSFA, which both have all kinds of first-time buyer programs. Some are restricted by income, some give you benefits by the job type. Are you a first responder, a teacher, or medical? And income restrictions, that's another question. Most of them have some kind of income restriction, but not all of them. So I think the best thing to say is there are tons of first-time buyer programs, and the person that can really, really answer your specific questions is the person that you're talking to about getting pre-approved, because they're seeing what you're going to qualify for. But you definitely want to let them know that you're a first-time home buyer and interested in looking into those programs. They're out there, they're available, and for a lot of people, they're really beneficial.
That's great. So someone doesn't need to go and research all that and know what programs they're going to ask the lender for. They should be asking the lender, what programs would I be eligible for given my income, given my credit score, given my first time home buyer status, the lender will give them that information.
I mean, I think that's a great place to start. But hey, I'm never one to tell somebody not to do any research on their own. You know, it's Thursday night, you're sitting in front of your computer or your tablet or your phone. And if you're inspired to look up down payment assistance programs in, you know, the city you're in or whatever, don't hesitate to do that, because sometimes you could find something that the lender doesn't know about, because once again, nobody knows everything.
Good point. Good
Good
point.
point.
Great, thanks. Austin, you know, first time home buyer, that often comes into down payment. You know, so often people think that they need a 20% down payment, and that is a lift in this community. It's very hard to get 20% down. Does someone really need 20% down? Are there other options?
No, there's definitely not a need for 20% down. Now, it'll depend on the sales price, because the low down payment options are not necessarily available at a $4 million house. Like, we're not going to go live next to Oprah for $5, right? However, if you are a veteran, you may be eligible for a VA loan that could be zero down. As Roy started insinuating, there's so many down payment assistance programs out there. There's CalHFA. I'm sure most people have heard the Dream for All, which I honestly call the dream for some, because it's going to be a lottery program, right? Where there's shared appreciation. You can get funds from family, you can get funds from your 401k. So do you need 20% down? No, not at all. And I think it's really important to think too, because as we talked in the beginning, yes, we see rates coming down. However, we probably don't really see prices drastically coming down because there's not a lot of inventory. Folks have to remember that $100,000 in lending in real estate costs about $700 a month. So for some clients that are like, hey, look, I've got 5% down, I really want to save to 10% because my payment's lower, I'll have you keep that in mind. Like, well, what are you saving for and at what level? Because let's say you're buying a house for, $1 million, to make our math easy, right? And you've got 10% down today. How long is it going to take you to save 100,000? Versus how much more would that property go in the market, versus how much more could you go ahead and buy now with a lower down payment option and perhaps refinance in the future, right? So 20% down, it's a great option. It's available on most terms, but you don't necessarily need it. You can do as little as 3.5% down on a duplex if we do an FHA loan. 5% down, different lenders have different options. 5% down in our world is around $1.5 million. So gosh, Corby, great question, because usually folks say, I'm saving for a lower payment. And I go, cool. How fast is your saving compared to the market? And what does lower mean for you? Because if it's $700 or so, that's $100,000. And that's certainly a big price tag.
Yeah, that's a really good rule of thumb.
And if I
That's
may, on the
great.
first time buyer front, they're allowed to put 3% down on a conventional loan. So that's also a good point. And she is spot on. I totally agree with Austin. I don't know how many times I have a client say, hey, Roy, I've got my 3% down, but I'm thinking maybe I can scrape up another $10,000 to put down. How much would that help me? And I tell them $70 a month in payment. And they're really blown away. Their brain didn't compute that $10,000 only equated to $70 a month in payment.
Yeah.
And so sometimes it makes more sense not to put the extra $10,000 down and have that for reserves, safety money, or perhaps money that you need to fix the place up after you buy it. So great point, Austin.
And
Yeah.
that's why that relationship with the lender is so important. They're going to advise you that way. They're going to show you the numbers. And Austin, you talked about the nerd effect. And it's like they know the numbers. They're going to give you every number so that you can get in there and really make that analysis and see what makes sense for you. Austin, would you share a little bit about what mortgage insurance is? I know that's one of the options if you don't have 20% down. What is mortgage insurance? How does that impact someone? And what are the ramifications of that?
Great question. So in the state of California, if you're putting less than 20% down, you're typically going to have mortgage insurance. And I have to say it typically because perhaps you could do a first and second mortgage. Mortgage insurance is when one single loan is at that loan to value. So in our $1 million price point example, because that math is super easy, if you're putting 10% down at 90% loan to value, borrowing 900,000 as one loan, you would most likely have mortgage insurance, right? Now, could that mortgage insurance be paid monthly? Could it be paid up front at closing? Could it be perhaps rolled into your interest rate? There are options on how to treat it. However, it is technically there unless you do that first or second mortgage. And it's really important to remember too, on FHA loans, there is upfront mortgage insurance and monthly mortgage insurance for no matter how much you put down. So if you have 50% down and we're doing an FHA loan because that's the right parameters for your situation, you still have mortgage insurance. So certain programs are going to have that period.
Now with the FHA, I know a lot of agents will encourage people to look at that and it's, you know, a great loan with 3.5% down, but it seems like that mortgage insurance is quite a bit more expensive than on a conventional loan.
Yeah, because FHA mortgage insurance is irrelevant of your parameters, your personal parameters, whereas conventional insurance, which they call PMI or private mortgage insurance, is really based on personal parameters. Again, for example, if you're putting 10% down on FHA, your mortgage insurance is set at a certain premium based on your loan amount and the loan to value, period. On conventional, it's based on your credit score. Are you a first-time home buyer? Is it an affordable housing program? There's so many more mousetrap type parameters. So, for example, we had some clients the other day where they were told by their lender that they came pre-approved with of like, nope, you have to do FHA. And I said, well, why? She's like, I don't know. That's just what they told me, right? And that's not anybody that's on the CHP list, to be clear. And I said, well, why can't you do it this way? What if you do it this way? And they're like, we've never had those conversations. So you are absolutely correct that FHA does have a certain level of a mortgage insurance period based on the loan amount and how much down, whereas conventional loans are really going to be based on more your credit score, again, the loan to value, AKA how much down, but the type of program that's being done as well.
Okay. Well, and again, my takeaway is going to be there's a lot of loan programs out there that don't need a big down payment. Go see the lender. Let's find out what these are and don't kind of say, well, I'm waiting till I've saved a certain amount or till I make more money or till I get a promotion. Find out where you are now and see what that game plan is. So so important to have that really solid lender relationship.
Yeah,
Right.
I
Yes.
think, Corby, just to bootstrap onto that, I can honestly say that at my office, there's about 10 loan officers. About 60% of all of our purchases, maybe even a little more, are between 3 and 10% down, and more between 3 and 5% than you would think. So I would actually say that there are more loans that we're doing currently at the 3 to 5% down, 3 or 5% down than even the higher down payments. And so it's a lot more it's being used a lot more than you would think.
Well, that's encouraging because that means that more people are ready to take this step. So great.
Sure.
Well, so Roy, you know, we keep talking about how important that relationship is with the lender. How does someone select a lender? You know, what do you look for? How do you choose a loan officer?
Yeah, that's a great question. You got to try and answer it without being biased, right? I think what I kind of think in my own mind is a great place to start is referrals. Like everybody knows somebody that owns a house, just bought a house, a friend, a family member. That's a great place to start because you're talking to somebody who actually lived the 30, 60, 90 days conjoined at the hip with the lender and had a good experience, right? So that's a great place to start. Also, I think the internet is a great place to actually just kind of see local people in your area and, you know, kind of look them up, look at their reviews, which is also the next step after you get a referral from a friend, family member, or your realtor. The realtor is also a great place to get referrals from because at the end of the day, the realtors care about taking care of the client and the purchase closing. It's that simple. Taking care of the client and the purchase closing. And depending on the realtor, the order may get flip-flopped. But at the end of the day, it really is a referral that's usually based on performance. So a realtor is also a great place to get a loan referral or not. But when you get the referral, you want to definitely take a minute. We've got this great tool with the internet. Go on, take a look at the reviews and everything. And sometimes it's not even about the reviews. You never know what makes someone not click with someone. And if for some reason you just don't get the right vibe, hey, there's tons of other lenders out there. I always make the joke that sometimes you just got to look around a little bit, even if they're referred, to go do some investigation on your own. And sometimes it's something as silly as the guy reminds you of who stole your girlfriend in high school 30 years ago. I mean, you never know what might make you uncomfortable with somebody. And I think that that's really my point. You're choosing to work with somebody that you're going to be dealing with for 30, 60, 90, 120 days potentially. You definitely want, to me, in my opinion, to connect with somebody that you want to go through that process with, as well as them having the prowess of the knowledge of loans and all of that, how they communicate. Do they communicate in a way that you like to communicate in, etc.? So that's kind of my short, long answer.
Good. Now, I know a lot of people will say, well, I'm going to, shop for a loan officer by interest rates. Who's got the best interest rates for me? What's your take on that approach?
I think interest rates are important. I do. Because it's the foundation of your payment. But you have to remember a couple things. Any interest rates that's being quoted to you today isn't necessarily the interest rate tomorrow. And even if interest rates were 1% on any given day, when you talk to somebody and ask them what the rate is, they're not able to lock that rate in for you until you get into a purchase contract. So that rate's going to be moving around. So I think the rate is important, but I think the rate becomes more important after you've found somebody you want to work with. If that makes any sense, right? Find someone you want to work with. And I think everybody's here to try and give everybody the best rate possible. Loan officers don't make more money because they gave you a higher rate. So there is an incentive to give you the best rate because there's no incentive not to. So even somebody that would be removed from caring about their customer still has no incentive to give you a higher rate because there's no reward for that. So rates are important. I do think they matter. To say otherwise would be foolish. However, I do think that you've got to take everything in totality. I personally can say there have been times in my life where I might have done something that cost a little bit more because I really liked the person that I was dealing with. I liked the way that they helped me, etc. And so at the end of the day, I think you just got to look at the whole picture. It can't just be on the rate, in my opinion.
And a lot of times, like you say, it's chemistry or connection. Do you feel like you relate to that person? So that's just a very personal choice.
Well, I think you're building your team, right? So you're definitely building your team. As you said, Roy, rates change all the time, right? So we might beat Quicken one day and Quicken might beat us the next. You could be higher one day, I could be low, higher the next, right? Rates are so individualized, and you don't pick your doctor based on getting a Groupon, right? This is the most important financial decision in your life. You are literally putting all of your money on the line, right? So you need to make sure that you want a good, reputable human that you get along with. You like their communication style, right? You feel cleared and heard. You feel that your needs are met. Is lending perfect? Absolutely not. I mean, think about how many if thens we've mentioned on this call, right? So it's always best to make sure you're building that team that's going to have your back overall.
Right. Awesome. Well, let's go to your questions. Kim, do you see some questions in the Q&A?
Yes, we have 3 questions here. So I'll start with the first one. The first one says that they're interested in a multifamily property with rental income. What are the lending differences with this and a single family home?
Austin, would you take that one?
Yeah, that's a great question. So, couple things. First and foremost, I think a lot of people say, oh, well, I'll just live in the back house and rent the first. That doesn't necessarily work in all situations. So, can you use rental income to qualify when it is a true multifamily? 90% yes, right? 90% yes. So we're not talking about an illegal garage for conversion. There are some instances when it can be an ADU. However, depending on the type of loan, it's either going to be based on the rental market that's available, right? It's a vacant unit, and this is where the appraiser says the rental market is available, A, and or B, the actual tenant in the property. So if Corby's renting a house from Roy for $1,000 a month and the market rents 5,000, you don't get to qualify on the 5,000. You get to qualify on the actuality. You may need to do a little bit more money down in those situations as well, but it's a great way to get in and what some people call house hacking to help offset and subsidize your mortgage payment.
Great, thank you.
Thanks, Austin. The next question is if they have a loan, is a loan from a 401k recommended to help towards a down payment along with the home equity line of credit? How much can I borrow from retirement and what are the pros and cons of that?
Roy, you want to take that?
Sure. So if you're buying a home and part of the money that you're going to use, let's just say you were going to put 10% down for conversation, and let's say that closing costs, taxes, insurance, and prepaids were $7,500 for closing, $7,500 for all the rest. So you would need a down payment plus $15,000, and let's say that that came out to $35,000. Part of your plan as the person that wants to buy this property was to take money out of their 401k. If that's your case, I seriously would say borrowing from your 401k may be a better avenue for you to go. It does a couple things, and this is just my opinion. A, if you're not if you're going to take money out of your 401k, you're going to get a penalty, and you're also going to owe the tax on it. If you borrow the money from your 401k, then you don't actually get hit with a penalty or taxation because it's a loan, and you're actually borrowing the money from yourself. So the interest that you're paying, you're actually paying to yourself. And because of this, we don't have to take that monthly payment to your own 401k into account when qualifying you for the home. So if your payment to your 401k is $250 a month, we don't have to add the $250 to your monthly debts when we qualify you to see if you can buy the home. And so for that reasons, I think that borrowing from your 401k is a very viable source to be able to get funds from. How much can you borrow was another part of the question. Generally speaking, 401ks are set up by each employer. So the only way to answer that question is you just reach out to your administrator of your retirement plan or your 401k and simply ask the question. Most of them that I've seen are around 50% of the vested balance. But I'm just kind of giving you a generic, every 401k has their own rules and they could be different. So you got to check with that. And I'm sorry, Kim, could you prompt me on what the other part of the question was? Should you do it? How much can you take out? Oh, you're muted.
You're muted.
Sorry. How much can you borrow and what are the pros and cons?
Gotcha. Okay, so we talked about the pros for a minute. You can qualify taking that money and not get hit with the payment. You're borrowing money from yourself and you're paying your interest to yourself. So those are the pros. The cons, that you have a payment, right? And even though we're not calculating it in all of your expenses, you still have that payment on the side. So you got to take note that, hey, not only do I have my, $3,900 a month in principal, interest, taxes, and insurance and mortgage insurance, but I also have another $300 for my payment to my 401k. And remember, we're not calculating that all in any of our stuff. So that would be a potential con because maybe that $300 affects your quality of life. I mean, it's no fun to go to the drive-thru and not get French fries with your Big Mac because you're broke. So at the end of the day, that would be something I would just say, hey, let's just make sure you're okay factoring that payment in. Even though we've already got you qualified for the house, because quality of life is important too.
Right. Thanks, Roy.
Thanks, Roy. The
Yep.
next question is, does my chosen lender / real estate agent have to be local to where I want to purchase?
Austin, would you take that one?
Your realtor definitely does, because the realtor has access to local listings or not. So realtors sign up for what's called MLS, the multiple listing service. And the MLS is where all of the listings are housed, right? So Corby doesn't access that. Roy doesn't access that. I don't access that. We're not realtors. We don't have access to active information at that type of level. So yes, absolutely. Lender-wise, I really highly recommend it. For example, we might know the difference between one condo having to go Fannie Mae or Freddie Mac because of their outside flood insurance policy based on the way they were set up after they were rebuilt from the builder's lawsuit, right? Like that's a random detail, but that's going to save you time and stress. We might know things that this is an age restricted community and this is how the loan's got to be processed this way. So I highly recommend a local lender. Is it required? No. But I'll tell you, no matter what is the right thing to do, whoever you pick as your lender, you start picking that person before you get into contract. When you're making your offers, you are using Roy's reputation, Roy's resources, Austin's reputation, Austin's resources to get your offer accepted. If you have any questions on what the numbers look like before the offer, we'll do it. That's easy. Roy can update that easy peasy for you. However, it is certainly not appropriate to work with someone and then flip once you're in escrow unless there's concerns or issues down the line. Like I said at the beginning, you're building your team. We have opportunities that other people don't. And we want to make sure that you have all the benefits of somebody that's local and knows these opportunities as well.
I'd like to add on to that, Austin, too, is that so often people try to go with an e-lender. And I just don't recommend it. It might work for refinance, but on a purchase, it's just, I've just heard too many horror stories on where things changed in the middle. You're working with a local lender, you can walk right into that office, talk to the manager. You have recourse. We're a small enough community. People have, reputations that will not be upheld if they don't behave properly. So I think that it's really wise to have a local lender and not an e-lender. And sometimes interest rates can be, pulling you into that direction, but that may not really be what the costs are. So you really need to be alert to that. And like I said, I've just seen too many horror stories in that direction, and I would highly recommend a local lender.
Mm-hmm.
Kim, are there other questions?
And the last question I can answer, it says, can I still use the benefits of savings on closing costs from the Coastal Housing Partnership if I have my partner as a co-borrower and he isn't part of the program? So just one of you needs to be part of the program and you need to use to get those discounts, you're using a network partner in the program to be able to take advantage of all of those savings.
And we are not just a first-time homebuyer program. Any employee of a member company can use our benefits. We've had people use our benefits multiple times. So they might, get a starter home. They might then use the benefit to refinance. And then as their family grows, they use the benefit again as they're buying, a move-up home. So we're not, there's no income restrictions and there's not a first-time homebuyer restriction. So
Corby, I did put the information for the home buying fair in our chat. That's coming up.
Good. Yes, April 30th. We have a home buying fair in Goleta. And this is a great opportunity to meet with Coastal Housing Partnership network partners. It's from 4:30 to 7:30. We provide supper, and it's just a great way to get more information about the home buying process. And we encourage you to attend. It's free. So great. Well, thank you very much for coming. And Roy, Austin, thank you so much for your time today and for your great sharing so much great knowledge and information. Really appreciate it.
Thank you. My pleasure.
Okay.
Bye, Corbin.
Thank
Bye,
you.
Austin. Bye,
Have a
Bye,
good
Corbin.
everybody.
afternoon.
Thank you so much.